On YouTube family, welcome to Credit King TV, your source of all credit information. Today's video is all about the top 10 credit myths that are still around. We're going to debunk all of them and answer all of them to see if they're true or not. So if this sounds interesting, stay tuned. And while you're here, hit that subscribe button and hit that like button. Credit myth we're going to debunk today is keeping a balance on my credit cards increases my score. This is simply incorrect. The reason for this is you're only doing two things when you do this. One, your utilization is going to go up. And two, you're going to be paying interest. Now, the first part, your utilization is 30% of your score, which means any balance you do carry over, your utilization is going to go up. Now, we all know the higher utilization rate, the worse it is. But even if you say you're at 10% utilization, you're still missing out on some points. And then the second part is paying interest. Most of these credit cards are anywhere from 15 to 25% APR. So you're going to be losing out on money every time you keep a balance on your credit cards. Now, what I normally recommend is trying to pay all your credit cards in full every month. There are two ways to not pay interest. And I know there's some people who like to keep the utilization very low at 1 to 3%. And if you want to do this, the way to do it is leaving a very small balance before the statement date closes. This is because the credit bureaus actually pull your credit information when statement closes. And then what you do is you keep that small balance and then pay it in full by the due date. There are two different dates there, so keep that in mind. If you pay it by the due date in full, you're still not going to pay interest. So that way you could keep a 1 to 3% utilization. Or if you just want to keep it at 0%, just pay every single month before the statement date and you're not going to pay interest. Now, a lot of people get scared with the whole 0% utilization, and I'm going to put it this way. Anytime you swipe your credit card and you pay it, that shows activity. There's a difference between inactivity and a 0% utilization rate. So I hope this kind of debunks this myth. And if you have any more questions about this or have a comment about it, leave it in the comment section below, and I will try to get to you about it. Number two that we're going to debunk today is closing an old credit card will not hurt my score. This is incorrect as well. The reason for this is anytime you close any account, your credit history on that account is gone, and your credit limit on that account is also gone. This means if you've had 10 years and a $5,000 credit limit with that card, you've now just removed it from your account. So this could hurt you on your credit history and your utilization rate. And then to top it off with a little cherry on top, if you had any late payments on this credit card, even if you close it, you're still going to have that late payment on it. So you're getting no benefit off of closing an old credit card. Moving on now to myth number 3. Checking my credit score will hurt my score. This is actually incorrect. The reason for this is there are two types of inquiries. One is hard inquiry and the second one is soft inquiry. Every time you check your own score is actually a soft inquiry. Whenever you do these, this does not hurt your score at all. This does not affect it. Whether you're using apps like Credit Karma, Experian, or MyFICO, these shows your scores and is not going to drop at all. Now, whenever somebody else pulls from your credit report, that's actually called a hard inquiry, and that's what affects your credit score. So just remember that next time, or if you're afraid to check your score will not drop if you check it yourself. Number 4, having a higher paying job will increase your credit score. This is highly incorrect. The reason for this is you could have somebody who's multi-millionaire making $5 million a year, have a credit score of 590, and on the other hand, have someone who's making $12,000 a year, have a credit score of 820. The reason for this is your income has nothing to do with your credit report. The credit report has everything to do with how well you do with money that you borrow. This is mortgages, credit cards, car loans, and so on. So again, that myth of having a higher income to have a higher credit score is just false. Number 5, there's only one credit score. This is actually incorrect. There are actually a lot of different credit scores. The main ones being FICO, Vantage, and then the other sub are like mortgage FICO, car loan FICO, and so on. The reason for this is different lenders look at different type of scores. Now, my opinion, I would say just try to focus on your FICO score. If your FICO score is increasing, 9 times out of 10, all your other scores are increasing as well. So just keep that in mind. To the next credit myth. This one is late payments are impossible to remove. Now this one is actually pretty tough to do, but it is possible. If done correctly, these late payments can fall off your credit report. There are two ways to do so. 1, disputing, and 2, goodwill letters. To dispute, you could either do it online or send letters to the 3 credit bureaus. Now, this is basically when you tell them to verify that account. A lot of the times, these credit bureaus cannot verify these accounts. So under the Fair Credit Reporting Act, they have to remove them. Once removed, your credit score will go up. The second way is to send goodwill letters. These goodwill letters are sent to the creditors, not the credit bureaus. And it's basically when you tell your side of the story onto why you had that late payment. So you're basically admitting to it, but you have to sell it. You have to give them a real good reason to try to remove that. If done correctly, they can't accept it and they can't remove that late payment off your history. So look into both of these ways and this will help out your score big time. To myth number 7. This one is being a cosigner will not affect my credit score. This is incorrect. Now, what happens when you become a cosigner is you basically agreeing to have that account with your credit report. Now, what happens is they first do a hard pull on your account, so your score is going to drop off of that. Then you're also getting that loan on your report. Now, this means, let's just say that person is not responsible and have late payments on that account. Now you're going to get affected and you're going to get late payments off of that account. So remember, anything you do or anything that person does with that loan, you're going to get affected with it. So just make sure if you are going to co-sign that it's with somebody responsible and someone who's going to pay their bills on time. Because again, being a co-signer does affect your score. Myth number 8. This one is paying off collection will increase my score. This one is a no-no. If I had a red button right now, I would be hitting it saying don't do that. The reason for this is when you pay off a collection bill, they report to the agency, and this is actually a negative mark. You do not want that mark on your credit report. Now, if you were to pay it, the only way to do this is to tell them, I will pay it in full if you do not report to the credit agency. Now, this way, you will pay it in full, is out of your way, and it does not report as a negative mark. So again, paying off your collection does not increase it, it decreases your score. To the next myth. This one is all bills affect my credit score. This one is not true. There are some bills that do not report to the credit agencies at all. These are utilities, cell phone bills, insurance, and so on. The only things that affect your credit score are loans such as car loans, mortgages, school loans, credit cards, and business loans. So just keep that in mind. Just because you pay your light bill every single month on time does not mean your score is going to increase. So just remember that. On to the last and final credit myth. This one is having a lot of credit cards are bad for your credit. This is not true at all. The reason for this is having a lot of credit is actually good for you. One, you have a higher credit limit, which means you can spend more without hurting utilization that much. Two, you have more accounts. The more accounts you have open, the better. And then 3, you could use these credit cards for rewards such as cash back, travel rewards, and so on. Sometimes some of these credit cards also have subs, which is when sign-up bonuses. When you open a new account, you can get $150, $200 back, and so on. So there's a lot of benefits of having a lot of credit cards. Now, having a lot of debt on these credit cards are bad, but just having these credit cards alone are not bad. You should have to know how to use them and how to play this game. We have just debunked the top 10 credit myths that are still around and that people still believe in. If you learned anything in this video or have any questions, comments, or concerns, leave them down in the comment section down below. I will be replying to them all. And while you're there, hit that like button and hit that subscribe button. Remember, this is Credit King TV, your source of all credit information. I'm out.